Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our guest on the show today. Joining us today are Sharmila, Joshi and Vivek Mavani, who are independent investment advisors, along with Sangeet, Lakkar of Newberry Capital. Today on the show, we talk about whether DLF is a stock worth accumulating after the management clarified in response to the Supreme Court notice. We discuss whether Bharat Electronics is worth an investment after Morgan Stanley turned bullish on the counter. Edelweiss is seeing a rebound in today's trade. The stock had fallen to double digits on Friday after it clarified on some of the exposure it has to Kohinoor Mills. And finally, we ask our analysts about one stock that they would recommend to their clients either on the long side or the short side. But let's start with the first stock, and that is DLF. Now, the counter did manage to fall almost 20% in trade on Friday. Again, managed to recover half of it on Friday, but today it's trading flat in trade. There was a case in which there was a notice sent to the company in terms of some bit of issue, non-disclosure on their QIP. We spoke to the management, and the management said that this was vested interest, and certain groups have been doing the same ever since the QIP came in. The report also said that if it is found guilty, they will have to return the entire 5,000 crores to the investors. Now, the management is defending its move. Whatever happened has happened. The counter is down in trade. But what next? We ask our guest here whether they believe the management and whether DLF is worth an investment at this point of time or no. Vivek, you heard both sides of what the report said. The management clarifying that it was a 5-acre land, and it was not a subsidiary of theirs, and that is why they did not have to disclose. At this level, is real estate or DLF worth any kind of money that needs to be put in?
I don't think so. As far as notwithstanding the clarification, I mean, every management has a right to clarify and attempt to come out clean for whatever their deeds or misdeeds of the past. I'm not making a judgment on that. I mean, there is a regulatory system and judiciary which is their job to do that. But as far as I'll break it up into two. As far as sectorally, real estate continues to go through prolonged stress on back of oversupply, very muted demand, and whole lot of unfinished projects across all geographies, across all the developers, and that stress is unlikely to ease off anytime soon. So a DLF, for all its bravado, can't really escape the overall macro situation that prevails in the real estate sector. Relatively, it may be better because they have I would say monetized some of their assets and got some foreign partners to fund some of their rental yielding assets and so on and so forth, but it's certainly not been enough, number one. Number two, market also not really appreciated that. If one were to look at the stock price performance for all the positive developments which have happened in the last 1 year, including after the latest clarification and that controversy and so forth. Now, just to cut the long story short, over the last 10 years, I mean, what DLF at 150 rupees, what we are seeing is a stock price which is 85 or 90% lower than its peak done in 2007, 2008. I mean, more than 10 years ago. And 10 years, if we were to see their earnings performance, stock price performance, I mean, that itself tells you the story. And there is generally a consensus opinion, whoever you talk to, that the management has been dodgy. The management has been adventurous on a whole lot of things related to corporate governance, disclosures, management practices or business practices, and it's not that they have not been pulled up in the past by regulators or the judiciary. So with that kind of history, I don't really sense an opportunity from an investment point of view for DLF even at 150 rupees. At best, from time to time, you may get some small trading bounces of 15-20%. So this 150 could go back to 180, which is what it was about a week or 10 days ago. But I don't think one should be really be adventurous and try to play for those trading bounces, because most likely they could be more of traps than an opportunity.
Okay, Sharmila, is that the similar sense that you said DLF probably could be a trading bet but not an investment bet, or you have a different view?
Well, I wouldn't comment on trading bets, but yes, I think, to just answer your question when you were alluding to it earlier, I think when the management comes and clarifies, it's always good, and I think there have been certain sections of the market which have taken their clarifications positively. But for me, the concern is on the sector, as you said, okay. Because I think, I was just reading a report over the weekend which suggested that in the homes, meaning that part of the real estate segment, not the commercial segment, the home buyer segment. You're seeing an inventory which would take 2 years to clear out.
Yeah.
Then again, you're seeing that the investment that was available to them in terms of funding, that's halved. So, I think the concerns on that front are many, and this is the data which is available only for the metro cities. Who knows what the picture is in cities other than the metros. So this is for me not the segment, not the sector to be in. Also, I would agree with Vivek that like not just for DLF, but I think that for a whole host of real estate stocks, corporate governance has always been an issue. So by and large, this is a sector I've avoided and I would continue to avoid it.
Okay, Sangeet, is this a similar view that you share?
No, I share a contrary view. I'm actually positive on DLF.
Okay.
I may not be so positive on the real estate sector, as pointed out by Vivek and Sharmila, that the sector is going through a stress. And it is unlikely that the pricing will improve in next 6 to 12 months, considering the liquidity crunch that we are facing. But if you look at DLF, I think there's a lot of underneath story which is going on for the last 1 or 2 years. From a debt of about 27,000 crores last year, it's now on the verge of becoming debt free, which I think the market is not realizing. The promoters themselves have infused about 12,000 crores, which is the entire sum which they realized from stake sale to GIC of their rental arm has been infused back into the company. That infusion has taken place at a price of 218. The QIP was successful. It got subscribed I think 2 times, again at a price of 183. Now, if we talk about valuations as such, the current market cap is around 36,000 crores. Out of this 36,000 crores, 20,000 crores itself is the value of the rental arm, wherein the GIC is the partner, and which is slated to grow at a healthy about 25-30%. They have about 11,000 crores of ready inventory. Yes, there's a concern. It might take about 3 to 4 years to liquidate that, but still it has some value, as I would perceive. They have about 204 million square feet potential land bank. My best guess is that value also is about 15,000 to 20,000 crores. Plus they have some rental assets on their own books as well, other than the Cyber City assets. Taking all this thing together and looking at the valuation right now, and considering that it's almost debt free, just about 3,000 crores of debt, it's worth a bet at the current price. So I think I'm a buyer at the price.
Okay, and just a view, every now and then there are issues that relate to corporate governance that come out in DLF and a lot of other real estate companies. Are you not concerned about that?
So the current issue which has come up, I think the management has very well clarified. One is it's not a material issue. Second, it is not even a subsidiary of the company. And a similar issue was there earlier as well, which was very well settled at the SAT level. So the judgment was in their favor. So I think this is more of a noise, and you see the stock price has recovered, from that lows. So yes, I would be little cautious about it, but I don't think the current issue which has come up is so material as to change the thesis.
Okay, that's the view that's coming in on DLF. What our guests have indicated, both Vivek as well as Sharmila, not at all positive on DLF at this point of time, but we have a contrarian view that's coming in where Sangeet is saying that he can take a contra bet on DLF. So that's the view that's coming in on the first stock, that is DLF. The next stock we want to talk about is Bharat Electronics. A couple of days ago, Morgan Stanley initiated coverage on the stock with an overweight rating. Nikki Mirchidani is telling us what the key highlights and what Morgan Stanley is indicating, and then we'll talk to our guest on their views on Bharat Electronics. Nikki, what do you have for us?
Well, thanks for that, Darshan. Essentially, Morgan Stanley is saying that it sees Bharat Electronics as the best way to play for India's defense indigenization theme. It said that the company's revenue CAGR between FY15 to 19 clocked a revenue growth of around 14.5%, vis-a-vis a spend of around 6.5% as a defense capex during this period of time. So clearly, that's our performance coming in from the company. It's suggesting that the government remains to be committed to achieve the target of lowering imports by as much as 30% by FY 2027, which is also positive for the company. And as a key strength, it sees sees the strong execution record, wide production range, and a diversified and large order book as the key strengths for the company. In terms of concern, it said that margins and working capital deterioration are largely priced into the stock price of the company.
Okay, many thanks for that, Nikki. Sharmila, I think you've read the report, you've seen what was also said. Every few years there is this defense theme that is played up, so probably Morgan Stanley is indicating that. Are you confident of the defense theme being actually played out, and are you bullish on BL?
So I think the numbers weren't particularly good. So I think that is something that could drag on for at least another couple of quarters, because that pain is there. It is quite evident in their numbers. Then again, I think coming to the defense piece, while I've always maintained that this is the best play for defense, and in fact I'd recommended the stock when it was in double digits, I think my concern also is that we haven't really seen orders flowing to these companies to the extent one would have liked to have, or what the general expectation was, that with that whole Make in India sort of an initiative. And very honestly, I think if you look at the budget also, the defense spend has not really been increased. I think in fact it's been marginally decreased this year. So you don't really see any big bounce in defense orders or anything in this year. So I would really use this pop to exit, because when I recommended the stock in double digits, my target was it was closer to 110, 115. So I think if you get close enough to that, you should just use it as an opportunity to exit the stock.
Okay, that's the view that's coming in. Sangeet, any view on Bharat Electronics or the defense space?
No, I don't track public sector units, so
Okay.
I don't have a view as such.
Okay, and what's your sense on Bharat Electronics?
Well, I'm extremely positive on Bharat Electronics, and you would recollect in the last 1 year, twice before we have discussed Bharat Electronics, and I have been positive on this. Basically, a couple of things. One is a play on defense indigenization, which a theme does play out. So, just taking on from the point which Sharmila mentioned about defense spending and so on and so forth, Bharat Electronics in the last 2 years, 5 years or 10 years, I mean you can take any number of years, has generally compounded their top line and profits at about 12 to 15%. So there have been periods of high growth and low growth. So when it's been a period of low growth, maybe it's grown at about 12%. A period of high growth, they have grown at about 15, 16% also. So that range. Now what we have today is a order book of 52,000 crores on hand. As of end of the first quarter, as reported by the management, their annual run rate has been about 10,000 crores of new orders that keep coming in as they also deliver on the existing. All of this at margins which are pretty much assured at about 15-16% EBITDA margins, which which would give them a return on equity of something like 19-20%. It's a debt-free company that generates huge amount of free cash flows. They did a buyback last year at 181 rupees, and yet they have, if I remember correctly, have surplus 2,000 crores sitting on the balance sheet as of March 19. I believe it would be little more as of June end quarter. From a valuation point of view, even at 100 rupees, it trades at just about 8 times EV by EBITDA and just about 12-13 times current year earnings, which for its track record and the growth potential, I think is pretty reasonably priced. I think it's pretty cheap also. So I would be a buyer on Bharat Electronics at declines. I would accumulate even at current price. If it were to fall further, I would accumulate more with a 3 to 5 year horizon.
Okay, that's the view that's coming in on Bharat Electronics. Just to recap what has been said, Sharmila has indicated that she would use this opportunity to exit. She has been rather bullish on the counter and had indicated, but she believes that it's priced in. Vivek is rather bullish on it at this point of time and believes for the long-term investment. Sangeet hasn't offered a comment. He doesn't track or recommend PSU stocks at this point of time. The third stock on the list is Edelweiss, and this stock also has been in focus of late. There have been some bit of clarifications. It has exposure to some of the real estate, and the counter has been, at least in this year, a massive underperformer. Swamit Sarkar is here to tell us what the issue was with this with Edelweiss, and what did the management clarify finally on Friday with respect to the Kohinoor Mills issue.
So earlier, if you see, there was a report on Business Standard which said that the ED is examining an investment of nearly 450 crore rupees made by Edelweiss ARC, that is the asset reconstruction company of the Edelweiss Financial, in Kohinoor CTNL infrastructure. However, the parent company of Edelweiss ARC, that is Edelweiss Edelweiss Financial did clarify that the probe is on the transaction belonging to a specific time period, that is from 2005 to 2012. Now, according to the company, in this time period, Edelweiss had no relation or transaction with Kohinoor. So currently, they are not under any probe. That's what the company said. Also, it said that the ED has asked for some information and understanding, and the same has been provided by Edelweiss ARC to the Enforcement Directorate. And in this time period, they had no relation with Kohinoor CTNL infrastructure. Now, according to the company, Edelweiss ARC did buy loans through various auctions starting from 2015 of Kohinoor, and the total exposure that they have is close to 120 crore rupees, as against the reporting done by Business Standard, where it said it had an investment of close to 450 crore rupees. So this is what the company has clarified, while the share prices did tank on Friday around nearly 13% on the Business Standard report.
Okay, that's the view that's coming in on Edelweiss. We'll talk to our experts on it. Sangeet, it's becoming more of media reports and then clarification. One more company after DLF, wherein the management was supposed to clarify some bit of thing. It's been a massive underperformer. It had a good rally, at least over the past few years. But what's your sense now? What should one do? It's come down to much lower levels, but what should investors do on Edelweiss? Are you concerned, or are you fine with what's happening?
So again, another classic case of noise, I would say, because the investigation does not even pertain to the period when Edelweiss had taken it over. Plus, it was an ARC exposure, which they have facilitated, and they have also clarified that the units are now completed, and they have also started giving possessions. So I don't think that's again an issue. Now again, on the company, I think Edelweiss looks interesting to me. If you see, they have successfully, so they had guided last year that they want to very clearly bifurcate their businesses into 3 separate segments. One is the advisory, second is the credit, and third is the insurance. I think they have successfully done that this year, and they have got strategic partner in each of their 3 verticals now. So if you see the credit business, they have CDPQ. In the advisory, they have just gotten Cora Investment, and in the life insurance, they already have an existing partner. So again, I believe the market is overpricing the credit risk. I'm not denying the stress which would be there on the books. About from the 40,000 odd crores of credit book, the mortgage exposure is about 11,000 crores. But they have a 2 times collateral. So, and they also have in all their projects an escrow arrangement wherein the net proceeds from sale directly comes to them and not through the developer. So it's a matter of pricing. Tomorrow, if they have to undercut, I think that liquidity will come through immediately to them. So I don't see a major risk from that perspective. In terms of earnings, the normalized profits is about 1,400 crores, and the last quarter was muted because of the enhanced provision that they had taken. Out of the 1,400 crores, close to about 55-60% comes from the asset-light business. So I'm not too concerned about the sustainability of that. CDPQ's investment and Cora's investment has been very recent. So I'm presuming that the valuation which they have given is considering the current stress and the due diligence that they would have undertaken. So if you do a valuation, a simple back of the envelope calculation based on the valuation in which these investment funds have been invested, the credit business is easily valued at 10,000 crores. The advisory business is valued at 8,000 crores, and minuscule insurance business, even if I value it at 1.5 times EV, it's about 1,000 odd crores. The current market cap is around 9,500 crores. The total of the sums is more than about 20,000 crores or so.
Okay.
You also have an astute management on board. They have demonstrated capabilities. Yes, they have a tendency to be aggressive, for which I think now you're seeing the repercussions a little. But I think it's again a case of market being unjust, and maybe they are operating in a space which is most hated by the market.
Okay, that's the view. So the positive view that's coming in on Edelweiss. Vivek, you share a similar view on Edelweiss?
Well, I have a slightly different view, and I'll explain a view from a slightly conceptually about the valuations. Yes, it is part of a market segment that is currently out of favor, and all companies go through periods of high growth and low growth, and correspondingly on the valuations, they go through period of re-rating when valuation multiples expand, and period of de-rating when valuation multiples contract. Edelweiss has historically traded at price to book of about 1 to 1.5. That was until 2015. Even in 2016, post demonetization, if we look at the period post demonetization, it was trading at about 1.5 times price to book, with book value at that time being about 60-65 rupees, and the stock price was 100, and the stock price is back to 100, and today the book value is also roughly about 100 rupees. It's back to one time book, but in between it had gone to up to 4 times book about 18 months ago, when the stock price was up 300 or upwards of 300, when last year the book value was perhaps about 85 rupees. So basically what I'm referring to is that over a 5-year period, an entire cycle has played out in Edelweiss of a period of high growth and and some business challenges now, and hence a period of valuation multiples expanding and now valuation multiples contracting. Market has been pretty ruthless on this count, although among the most favored sector in NBFC, Edelweiss certainly is among the better ones. I would say probably the best if we were to compare it to an IIFL or a Motilal or a JM Financial, because I think these are the other 3 only comparable companies that one can look at. Yes, one can also say it can compare it to Reliance Capital, but we know what's happened to Reliance Capital. Now, typically when a sector goes out of favor, even the best stocks do get battered, and we have seen that in the past. The only way the new cycle will start is consistent growth or some value unlocking triggers, which for Edelweiss, given the variety of businesses that they have in the various subsidiaries, they do have that potential, and they have done that recently. As far as their ARC business is concerned, there was some talk about raising some money by monetizing some small holding in the wealth management business as well. So those levers are available with the company. More importantly, over the longer term, of course, it's consistent growth year after year, which brings the favor back into the company, because at some point of time, it just becomes ridiculously undervalued. I don't see too much of a downside, but I don't see much of an upside either in the near term, because the sector will continue to remain out of favor for a while, and so will Edelweiss. Okay. So I'm neutral on that. I mean, no, not much of downside, but not much of upside either.
Okay, Sharmila, what's your sense on Edelweiss?
So, I think that one of the reasons why the stock did whatever 4 times book, whatever, what Vivek was referring to, I think, at one point in time, about 18 to 2 years back, one of the attractive things that was being looked at for a lot of stocks within this space was the ARC book. Because, suddenly there was a feeling in the market that these players who took these assets in these ARC assets, they would see a good playoff, going down when you saw a good recovery on that side of the market. But unfortunately, that has not played out to script in these last year and a half. And in fact, we are now at a place where we could actually see a worsening because the way this whole ILFS thing has blown up, and the ripple effect of that is happening. We don't know where are the pockets that there could be further pain for a whole lot of these companies, and which is why we've seen a correction. Because I think the older businesses that they were in, they would not have got this kind of a valuation. So this valuation, I think, was coming. They were getting this because suddenly market perceived this as a very something that was going to reward, the risk that they were taking very handsomely, and that has unfortunately not played out for these stocks. So while I would agree that maybe there is not too much of a downside from current levels, because obviously I think if you look at the numbers, there is that are coming from their other pieces of business, there doesn't seem any real stress there. But I would really avoid the stock for now.
Okay, that's the view that's coming in on Edelweiss. I think we've got 3 different views that are coming in on Edelweiss. Stay away. On neutral view is something that Vivek indicated. More pain is probably what Sharmila indicated. Sangeet is indicating there is more bullishness. He believes that the market value is much higher than what the current market is at this point of time. We're running out of time, but very quickly we'll get to the 4th stock, and is a stock that we'll ask analysts that they're recommending to their clients, at least on the long side or the short side if it's on the FNO side. Vivek, what is it that you've recommended to your clients recently, or on the long side or short side?
Yeah, so there's a company, again, sector out of favor, company out of favor, JK Tires, and the stock has also got battered. So the stock price is about 56, 57 rupees. But to me, valuation is attractive, because when I look at beyond all the bad news and negative news related to auto and auto ancillaries, what we would have in JK Tires is a very sharp delta on improving margins, on deleveraging, because all of their capital expenditure is done with. What we have is a peak debt now, so from here there's going to be deleveraging and hence savings in interest cost and improvement in valuations also. The expansion of margins will also aid return on equity, return on capital, and probably for a couple of years you will have a company that would generate positive free cash flows. So from a valuation point of view, a company that generates annualized basis 11,000 crores of top line, annualized about 1,000 crores of operating profit, that EBITDA has got a market cap of about 1,400 crores, which to me is quite cheap. Of course, they have 5,000 crores of debt, which is a concern, but as I mentioned, this is a peak debt, and from here we should see a cycle of 3-4 years of debt significantly coming down. They have gone on record that next 3 years debt will come down by more than 2,000 crores.
Okay.
So that I see as a positive trigger, and I think the stock has bottomed out at 55, 56 rupees. I'm a buyer. So a disclaimer, have a personal interest as well as interest on behalf of clients.
Okay, JK Paper is something that...
JK Tyres,
JK Tyres is something that Vivek has spoken about. Sharmila, which stock have you recommended to your clients recently?
So I'm going with IT. I think the reasons for that are obvious. Given the way the rupee is trading, etc., it makes sense to get into export sort of oriented sectors. And within that space, I've gone with Persistent System. I think in the past I've recommended HCL Tech, so that obviously stays. But Persistent System, numbers were pretty muted this quarter, but I think one of the reasons why the numbers were muted was that there was a management change, and sometimes when these things happen, you do take a couple of quarters to stabilize. So the kind of muted numbers were not really so much because of vertical specific issues, but more because of the management change. So therefore, I think that the stock has corrected, and the valuation that it's trading at now, even if you were to give it a multiple of, the overall sector may be getting multiples closer to 22, 23, but I think even if this stock were to get about a 15-16 type of multiple, you would still see a price of about 600, 610. That's the kind of price that I expect the stock to get to. So really more for valuation reasons and the fact that I like IT, I'm going with Persistent.
Okay, so second stock again based on valuation. And Sangeet, what have you recommended to your clients recently?
So I've gone with Bharat Airtel. Again, not.
You've been rather bullish on this for a while.
Yeah, sort of. So again, the thesis remains the same, but consolidated industry, just a 3-player market, no visibility of a 4th player coming anytime soon. Now, importantly, 2-3 levers to this. One is, so if you see the last quarter results also, the capex intensity has come down drastically. So they have also guided that the capex cycle is, they have done the kind of capex which was required. So that is giving one visibility to sustain free cash flow going forward. Also, the debt level at Jio is now looking to be a little worrisome. So, so I think that we should soon be able to see a uptrend in the pricing, and once a slightest indication of that happens, you will see a re-rating in all the telecom companies. Now, third lever is as Vodafone Idea grapples with the integration issues, we have seen that the Bharti Airtel is gaining their subscribers. So and it's going to take a while where Vodafone Idea will complete their integration, and there is a precedence, there is a global precedence that whenever merger happens between an existing telecom companies, the incumbent benefits because of the subscriber loss due to the integration issues. I think valuation wise also trades reasonable at about 9 times EV EBITDA, the India business. They have an Africa business also to support some case of valuation, although the dilution has happened, so they own only about 55% right now. But taking all these things together, I think it looks a promising bet.
Okay, that's the view that's coming in, and Bharti Airtel actually has done well compared to what Vodafone Idea has done. Vodafone Idea actually down in the dumps, managed to survive the Jio onslaught. So the stocks that were recommended today, Bharti Airtel by Sangeet, Persistent System by Sharmila, and Vivek spoke about JK Tyres. But with that, it's a wrap on today's edition of Hot Money. We are timed out on the show, but many thanks to my guests for coming in. Vivek, thanks so much for coming in. Sharmila, Sangeet, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg.